It's called Mortgage Coach. Mortgage Coach, MBS Highway. We have Mortgage Coach too. And we can really customize it with Mortgage Coach as well. But with MBS Highway, they've got these amazing tools that give us the capability of really streamlining the calculations behind all this. And it makes it very, very easy for us to be able to help you guys out and give you enough information and arm you with the data that you need to show a client like, hey, what, I'm waiting. Prices have gotten so high. I'm constantly hearing there's not enough inventory out there. We can't find the right home that we want for the price point that we're looking in. Our monthly payments are too high. The interest rates are too high. The sky isn't blue today. Like, I'll hear like every excuse under the sun why someone doesn't want to buy a house, right? Whereas just a couple of years ago, I mean, shoot, it was a feeding frenzy, right? To a certain degree, that feeding frenzy is coming back. If you guys weren't part of the stats meeting last week, I got a lot of good insight out of the fact that just in 1 week, in 2 weeks alone, it went down 500 units in San Diego available for sale. So we're at about 1,800 units total available, between 1,900. And if you put that into perspective, 1,300 homes, about 600 condos. Back in 2006, when I moved here, there was about 25,000 units for sale. We had a lot more to choose from. Prices were less expensive. Rates were just as expensive, right? They were still like floating in the 5, 6s back then, and people were still buying homes. The fact of the matter is that, yeah, prices have gone up, but at the end of the day, what's going to cause those prices to come down, right? And is it really about price though, right? Or is it about your monthly payment? Is it about that dollar amount that you have to come up with on a month-to-month basis, right? And helping people understand like what that dollar amount does for you, what that monthly payment will do for you, how it's going to help you build wealth over a period of time. That's our job. That's something that Matt and I religiously do with our clients and try to educate them on how owning a home builds wealth, generational wealth. This isn't something like, hey, I'm going to make a couple extra $100. We're talking like tens of thousands, if not hundreds of thousands of dollars over time, right? Especially here in San Diego. So look, at the end of the day, right, we have a shortage. There's not a lot of places for sale. However, there is going to be something right out there for everybody. Like, all the properties that are listed right now are going to sell. They're not going to just disappear. They're going to sell at some point. It's the right dollar amount, right, in that negotiation. So in helping people kind of understand what it is. So what kind of conversations are you having? What are you saying, Hope, to your clients? Like, if someone says, hey, I want to wait.
I let them know that the interest rate could go up, and then they're really priced out. Sorry, but I do let them know, that we can't guarantee, but inventory will always be low here. I also say that, which means the demand will always be there. And sorry, it's just the basics,
Sorry, yeah.
Of, do you want the interest rate to go up? Do you want your monthly payment to go up? Or do you want to take advantage of the market right now? It's just hard. For me personally, I haven't been lead generating the way I need to, but the buyers I do meet just aren't really that motivated. Sorry. And it is a financial thing.
A lot of it is,
Mm-hmm.
And the more and more people that we speak to, we talk to people every day. The demand is not going away. There's always going to be there's always going to be people that want to buy homes in San Diego, right? And so based off of that demand, we're constantly speaking to people. And nowadays, you don't have as many people coming in with 20, 25, 30% down payments anymore, okay? More or less, people are kind of scratching at the bits to be able to get into a home, right? Anywhere from like 3 to 5% down payment. We're seeing that a lot more often. with minimum down payments rather than people coming in with a lot of money down. And so that being said, what we did was Matt and I were kind of like just talking about it earlier. And look, at the end of the day, it's going to be what someone's comfortable with paying, right? So if you can help them find a home that you're comfortable with on a month-to-month basis, wouldn't it make sense to keep that money in your pocket rather than put it in somebody else's pocket? Because you're paying a mortgage, you're paying someone's mortgage. It's either yours or somebody else's, right? And so it doesn't have to be your forever home. You can buy something temporarily for now and then wind up buying something larger, something more grandiose that you want to be in for a longer period of time. But at least, hey, you might be buying a place now that you can rent out later on, that you can actually go out there and start your real estate portfolio, right? You don't have to wind up buying your forever home today. And so we did some calculations. I want to share this with you guys because this is a really important tool that we're underutilizing. And I think right now, more important than ever, we should be sharing this information with our clients so they can see this going on, so that they know, like, hey, we have this opportunity now to purchase a home. What is that going to do for us, right? So let's take a look, right? We used Kevin King's listing here as an example. Just went live this week, 720, probably the most competitive price point out there in San Diego, between $700,000 and $800,000, right? Annual property tax, I put it at about 1.5%. That's pretty high, but that's okay. Monthly mortgage and monthly homeowners insurance, $150. Shouldn't be much more than that for a $720,000 home. There's HOAs on this property. I said, hey, they're going to make, 24% tax rate, and it's a married couple that's looking for this, right? So this is my very conservative calculation, you guys. Super uber conservative, right? And so these are all the different parameters. Now, mind you, I can customize this for you guys with anybody, and it doesn't take long for us to do. And this will hit your clients in between the eyes when they're telling you that they want to wait and you don't have the artillery to get back at them with numbers, right? Sure, theoretically speaking, we can have the conversation all day long. There's not a lot of inventory out there. There's still a ton of supply. There's still a ton of demand. And basic economics 101 is going to tell you that, hey, high demand, low supply, what's going to happen to the prices? They're going to keep going up. It's a no-brainer, right? And no one's really going to argue that point with you because most people understand, supply and demand, like just basic supply and demand. So we overcame this on a theoretical level, but let's talk about it in real numbers. What does that look like, right? So let's scroll down. This is the cost of waiting. So say we bought this $720,000 property today, right? We put 5% down. Again, we're reverting to the folks that Matt and I have been seeing more and more of. We're not putting 10, 20, 30% down. We're putting 5%, okay? $36,000 down payment. Today's rate is in the high sixes. So we put 6.75, right? And a $250 mortgage insurance, just because they're not putting a whole heck of a lot of money down. They're going to have MI, right? So what's going to happen over the life of this property? Before I scroll down, let's take a look at this. Super conservatively speaking, right? In the next 6 months, it barely goes up. Not even 1%. Over the next year, it doesn't even go up 3%, right? So typically here in San Diego, we see an average, historically speaking, of about 5.4, 5.3, 5.4% over the past 50 to 60 years. That's just, it's been the average, okay? So I'm going half of that. Then I'm going to say, okay, so we wait 2 years. All right, so the property's only appreciated 5% in 2 years, right? Say we can change these again, you guys. So if you guys want to see like, hey, what do property prices go down? We can adjust these. But we already had that conversation with someone, right? Supply and demand. We don't have any. So can we agree that more than likely the prices of these homes isn't going to go down? Not a whole heck of a lot, right? So, okay, fine. So we've agreed on that. So say they moderately appreciate. So I've had 5% in 2 years and then another like 2.5%, 3% over the third year. Look at 8% over 3 years, not a lot of appreciation. Let's be honest. It's really low appreciation. But at the end of the day, I want to show somebody what this looks like. While this is all going on and it's very, very conservatively appreciating, for those of you guys that just joined us, we're going over a cost of waiting report. This is something that you guys all have access to. Just let us know. We can create this super easily for everybody. All right, and this is a very conservative estimate, a very, very slow appreciation over the next 3 years. Meanwhile, you have interest rates are coming down, right? We can all agree that rates are pretty darn high right now, you know, in relation to what they have been over the past decade. Granted, in the grand scheme of things, they're back to normal, all right, quote unquote, is what they've been averaging anywhere from 4 to 6%. You know, okay, so we're a little bit higher than average, but that's okay because it's healthy for the economy. Look at, so you have rates coming back down into the 5. So I'm thinking in the next couple of years, they should be in the low 5s. Hopefully, right? Fingers crossed. I don't have a crystal ball. Where's my, wait, hold on a second. Let me. Yep, no, cannot predict that one now, right? But we do have a magic 8 ball for you guys. So listen, nobody knows what's going to happen with interest rates, but we can all hope that they're going to come down. So for this, we're using declining rates and very slow inclining property values. So let's look at what happens over the course of the next 3 years. Your value does go up from 720 to almost 780. Okay. Your payments are going to come down over time, right? Because the interest rates came down over time. Now, here's the thing, right? Okay, great. So our monthly payments come down a couple $100, right? A couple $100. And this is a huge drop off in interest rate. We went from 6.25 to 5.25 from 1 year to 2 years, right? And then we kept it the same here on year 3, remember? So we went from 6.75 to 6 in 1 year to 5.25. All right. So sure, your payments come down. Look at your annual cash flow. Yippee-ki-yay. You got to save yourself $4,500 a year by waiting 3 years. Okay. And you waited for those interest rates to come down. But guess what? Property prices are still appreciating. They're not going to plummet. And even if they did, what is 8% in 3 years? 7.5%. Like, that's nothing for appreciation. Who doesn't think that properties are going to appreciate that much in 3 years? Come on. But look at what happens. Here's where you're going to hit somebody in between the eyes by having this conversation with them and showing them, wake up, like, properties are going to create value for you. They're going to create wealth for you. Okay, fine. In the first year, not that big. You're 6 months out. All right. So you would have gained $6,300 by paying down your mortgage. That's what amortization is, right? And by property appreciation. Now, mind you, that $2,700, that's a fraction of a percent in 6 months, okay? So you would have lost $20,000 after a year by less than 3%. Less than 3% in appreciation. But you also would have paid down like $7,000, right? So you would have lost in 1 year $27,000. So almost everything that you put down as a down payment, you would have gotten back after a year, year and a half. Okay. Look what happens after year 2. You guys, we set this up for someone that's like super conservative, right? Like, property values are barely going to appreciate and your rates are going to come down. So why wouldn't I wait? Why wouldn't I want to get a lower interest rate? This is why. Look at in 2 years what happens. $35,000 of appreciation you lost, and it's less than 5% in 2 years. That's pretty conservative. Is someone going to have a tough time arguing that point? $35,000. Oh, plus you would have paid off $15,000 of your loan. So you lost $50,000 by waiting 2 years. You got back everything that you put into that house and then some. Okay. Now wait 3 years and you lost almost $80,000. But hey, your monthly payments are lower. Oh, and guess what? We can lower your monthly payments in the next couple of years when rates come down. but you would have been paying down the appreciation, and your property values would have been going up and up and up this whole time. So your mortgage insurance might actually be less when we do refinance you, because you might not be at 5%, you might be at 10% equity, right? So super conservative, wouldn't you say? I mean,
For sure.
Rob, what do you think? I haven't seen you on here in a while, man. It's good to see your face.
Well, and that difference in mortgage insurance too is huge. That's cut in half. Mortgage insurance is cut in half the rate between 5% down and 10% down. Like, that's a huge drop and savings.
Yeah, it's like, homes ain't come down in value anytime soon. So waiting is just, you're costing yourself more money besides whatever interest rates are.
So, but look, Rob, I mean, in 2 years, you think property values might appreciate 5%?
Oh, at least.
You think they might go up in like 7.25%, 7.5%? In
I
3
would-
years?
I'd say in 1 year.
So okay, now we have numbers. Now we have those people that are out there that are, supposedly analytical and high D's that can go out there and like do the number crunching. They don't do the number crunching. You know how hard cost of waiting is to calculate? It's a pain. But look at the end of the day, okay, show your cash required. It would have been a wash after 6 months. It's barely any difference after a year. You would have had to come up with what, 2-3 grand, maybe more in 3 years. But this is what you're losing out on. The opportunity to pocket all this money. So this is super conservative. Let's look at something a little bit more aggressive. Okay. Let's just for giggles. So now let's say we're buying the same property with the same 5% down. Okay. The rates are doing the same exact thing. The only difference I have with this one is the fact that your properties are actually appreciating at what the historical levels are in San Diego. Okay. So now you're going about 5% in the first year, another 5% in the second year, and another 5% in the third year. Okay. That's historically speaking what we've been looking at. Everything else, you guys, I kept the same. All right. So now let's take a look at what your cost of waiting is. Hey, in the first year, you just pissed away $22,000. Oh, sorry. First 6 months, $45,000 in the first year. Oh yeah. How about 100 grand? Can you use 100 grand raise in the next couple of years? Would that help out? Right? Well, what about 150 in 3 years? And the only thing I did was change that super conservative adjustment, okay, to your price, and I gave you a more realistic looking one. $140,000, you guys, by 5% appreciation a year. People don't understand the concept of compound interest, right? Of compounding appreciation, of how these properties grow and what that impacts. So you have $140,000 today. Well, hey, guess what? If you have that $92,000 and you had put 5% down on this property, guess who's got 20% in equity now? Guess who's getting rid of that mortgage insurance in 2 years? There's $250 a month for you in your pocket. Oh yeah, plus we just lowered your rate. Right? So think about it. I mean, like, people don't think about this kind of stuff. They don't calculate these kind of numbers. It's too hard. This is not easy calculation. We have this awesome tool and boom, boom, boom. Let's change a couple of numbers in the loan scenarios and we're knocking this out. You guys, you're going to a buyer consultation? Call us in advance. Let us know what we're looking at, what the clients are looking at, and kind of price points they're looking at, approximately how much down payment they've got. We'll create these conservative versus aggressive ones for you. Let's be honest, like, that's not aggressive. You want me to throw 20% in there right here? That's aggressive, right? Nobody in their wild dreams would have ever thought that our properties are going to appreciate 20% a year for 3 years in a row, right? But I mean, look at $100,000 in a couple of years. That's not bad. And you're still paying down that loan by $15,000. That's money that you're taking out of your right pocket and you're putting it into your left pocket.
And for people who have kids that may be going to college and they're still paying rent, like, oh, how am I going to pay for my kids' college? I just found a way to do it in 3 years.
Do you want to learn how to pay for kids' college education? Buy a house. over time, you got little kids, you just had kids, over the next 10, 15, 20 years, 15, you're going to have enough money to pay for college if you own property in San Diego. Promise you. But I mean, look at the cash difference, it's marginal. $5,000 in 3 years, $1,000 2 years, 2,800. That's peanuts. This is what the conversation should be about. Should be driving these numbers home. This is what you guys need to be talking about. The cost of waiting. Do you understand the impact of compound appreciation and compound and just amortization, and like how that's going to impact how much money that you save by buying a home now rather than later? I think that if we start having this conversation with clients more and more, you're going to turn the tides on your business. You're going to be able to easily convince somebody by teaching them, by showing them, by educating them. It won't even be you convincing anymore. It'll be them being like, okay, let's get this done. Because there's going to, there's a right time for everybody. What did that report just came out with last week? It said something like 79% of the population, Gallup poll, said it's a bad time to buy. Where is it a bad time to buy? To me, owning a home is probably one of the most important investments you're going to do. And so you wait for property values to decline. You're going to be waiting for a long time with 1,300 homes and 500 condos for sale. I want you guys to keep this right in the back of your mind and make sure that you reach out to us if you have anything. We have a whole bunch of other reports in here. Besides the cost of waiting, we've got an equity gain report that we can show if someone has debt right now and they want to sell their home and upgrade their home. I can show you how paying off that high interest debt makes sense to transact now and taking a higher rate of return, a higher interest rate now. If you locked in a 3%, but you're paying 20, 30% on your credit cards, knocking out those credit cards with some of the equity that you've built over these years and purchasing something else, even with a higher interest rate on your home, you're still in a better off position. And we have the tools to be able to teach them about this.
Yeah, what's that interest rate doing for you if you're still upside down thousands of dollars a month in credit card debt and revolving debt?
And I don't know if you guys have seen the amount of credit card debt recently in the United States. Hold on, credit card debt, Fred. So Fred, you guys, is the Federal Reserve Bank of St. Louis. If you ever want to get any kind of statistical information, just type in whatever you're looking for along with Fred, and it'll drop in some wealth of knowledge for you. So look at what happened to credit cards.
Oh my God.
Okay. So remember, we hit COVID and everybody started getting their checks, right? Let's zoom in here. Everyone started getting their checks, and then boom, they started paying down their credit cards. Right? And if you were to overlay where these QEs, you'll see that it kept coming, and you can also see where it stopped. Because all of a sudden your credit card debt has doubled exponentially. We're sitting on a ton of credit card debt in this country. And a lot of people have buried themselves, absolutely buried themselves. Again, and this is since 2017, go back and you'll see how it spiked and how so many people needed to rely on credit cards, over that short period of time back here. And it's happening. It's even way worse now than it was back then, as far as debt is concerned. But also keep in mind that you have a lot of people that have a lot of equity in their homes. All right. Like I said, 63% of the country transacted in real estate over the past 3 years. So these folks are sitting on really low rates that they can dip into and leverage themselves, buy another property, pay off debts, invest, keep going in their finances. But some of these credit cards, man, just get overwhelming. I'm doing a loan right now, cash out refi for someone sitting on a 3.5% rate. She's taking 6 3/4, but she's got these massive credit card debts She got $50,000 personal loan that she consolidated a bunch of debts for. Now she's got another $40,000 in debts. And so instead of paying these exorbitant credit card fees, we're rolling it into the house and lowering her monthly payments and making life a little bit more breathable for her. And if she wanted to sell that house and move, she could easily do that. But she likes her home, so she's staying. But I just wanted to drive this home with this explanation and make sure that you guys are aware of how bad it is out there, and we don't necessarily realize it because that's not something that people really talk about as their finances, right?
Yeah.
But it's a serious problem in this country right now with the amount of credit card debt that we have. Student loans are still on hiatus. And so once they start doubling down and making you pay back your student loans and these credit card debts are piling up, it's setting up for a perfect storm at some point. And hopefully this government debt that we see and that we hear about, right, in all the news, I don't know if you guys have been listening to the news, but the debt ceiling needs to go up. Well, they need to rise. And so, there's this huge back and forth between the White House and Congress right now, Republicans versus Democrats, cutting expenses, spending, right, versus raising that ceiling and spending some more and making sure that we pay our bills. But at the end of the day, and I don't want to make this into a political discussion, but at the end of the day,
I want my retirement check.
Dude, there is no way that the government is going to default on their debts. Like, it's just not going to happen. Like, I've seen this like 3 or 4 times at this point in my lifetime, and every single time they wind up raising it. Like, of course they're going to raise it. You know how devastating it's going to be for the world economy, like not just our own, but for the entire globe.
The government needs spending cuts.
If they default, yeah, I agree. But I mean, look, at the end of the day, who are you and I to make that decision, right?
Exactly.
We're not going to default on their loans, you guys.
Right.
It's not going to happen. We got a printing and we got a money machine, right?
Yeah.
When you're talking like 3/4 to 80% of this world relies on that dollar so heavily, you can't sink the world and on purpose. You're not going to be in a good place after that. So it won't happen, but there will be a lot of volatility here in the next couple of weeks, and you probably will see people being a little bit more hesitant with making any kind of massive financial decisions, like buying a home. So just be mindful of that, because there is a lot of fear mongering right now, unfortunately, and it's all in the news. And
we're all gonna die.
Nah, we'll be all right. So, but I love your point of view.
Yeah. I keep seeing articles by, big media saying that it's an awful time to buy. And I'm just like, Jesus, can they stop saying that?
That's how they got ad dollars, right? They have to steer people, and they need viewership, and it is what it is. MBS Highway, I mean, he's an economist that started this website, and listen to him. Go follow him on Instagram. His name is Barry Habib. He's the guy that you want to be listening to. He's going to tell you like it is from an economic standpoint. And if there's stuff about to hit the fan, he'll let you know.
Right. And it's our jobs to be the experts on this. And it's the news's job to be the experts on selling fear. Like, our jobs is to get in front of people and show them what's really happening and show them what the facts, hit them in the face with it, and let the cards fall where they are with everything else. Like, our job is to make sure people know about this, scream it from the rooftops.
Yeah. We're here to educate and protect our clients at the same token, but also help them understand, right? So many people don't understand. So any questions, you guys? Anything?
I don't think I have any questions. I was going to ask earlier, but it might be a silly question.
Hold on one second.
My bad.
It is a silly question, so don't worry about it.
So the significant spike in the debt, do you think that is because of the interest rate hikes?
The significant spike in the debt is because people are losing their jobs left
Oh,
and right, and people just aren't making as much money as they
Yeah,
were.
layoffs.
Oh.
Especially with the housing sector. Think about it, like we're the largest industry in the United States, the housing industry.
Mhm.
And if you ask any real estate agent, I would say not any one of them, but a good like 90% of them, they've taken a pay cut in the past year. You
Yeah.
know, same with the mortgage industry. We're impacted just as much as you guys are. You know, we're
Right.
working 10 times as hard for a quarter of the pay. So look at the end of the day, like that's where the credit cards are coming into play. Like people need to leverage themselves, people need to keep living, people need to keep paying the bills. And so they're putting it on credit cards
Oh,
because they're not making as much money.
wow.
That makes sense?
Yeah. Sorry, I just didn't realize there were that
Don't be
many.
sorry. No, that's why,
Yeah.
that's why we're here. We're here to chat about
Thank
it,
you.
man. I love this stuff. I live, breathe, I read about economics all day long, every day. I love educating myself on it, and anything that I can share with you guys, I'll gladly share. So,
Well, I love it. Thank you.
Priscilla, what do you have? Great question, though. I can absolutely not hear you.
There.
There you go.
How are you?
Fantastic.
Good.
Good to
Just
see you.
one the other day, we submitted an offer for a conditional loan. And the next day, the lender told me, it was other lender, that buyers were not qualified anymore for conditional, but yes for FHA, and I panicked. But everything turned out okay. But is that
It sounds like a really bad lender that didn't do their due diligence up front.
Yeah.
You should never, ever, ever hear that.
okay?
Yeah, that
It's
is
like a no.
yeah, that's horrible.
Yeah,
That
it was like,
literally like how all of a sudden do you not qualify for a conventional loan? Like if that doesn't make sense. Like either credit wasn't run up front, either they didn't do their income analysis correctly. There was something that the lender screwed up and they needed to like play the shell game to like fix it. And they're like, oh shit, the only way that we can fix this is going FHA. Probably credit related. My guess.
escrow fell afterwards because buyers turned out to have a debt with the IRS. So
Yeah, they
I was
definitely
like,
didn't do their homework.
yeah, that's something that you should do, right? Like the lenders.
Yeah, and again, if you have a debt with an IRS and it's possibly in default, or you're late on it, if you don't have something worked out with the government on a payment plan, you can't get an FHA loan.
Okay.
So
Thank you.
and it has to come through clear with no delinquency, no defaults on any federal debt. Because FHA is a federal loan, it's a government loan. So I'm not quite sure if going FHA is going to solve a solution for you.
And with this
Did you close
newfound
on the property
yeah,
already?
and with this newfound tax thing, it might have blown the debt to income up because this is a new payment that didn't show up on a credit report.
Yeah.
So make sure, yeah, just make sure you have all your ducks in a row.
Thank you. I know what to ask next.
Yeah, just tell them to get a second opinion next time.
And if you have any more questions with it, Eddie and I are around all day. Hit us up.
Yeah, just hit us up. Like if anything pops up with your guys' escrows, even if it's not with us, you know we're here to help you guys. So just reach out and ask us, and we'll jump in and we'll try to answer those questions and figure it out.
Thank you very much.
Yeah, always, always. But yeah, like I said, second opinion can never hurt, especially when you're buying and you're spending $500,000, $1 million, you know? What's the worst that could happen? You get some additional choices. You might have different loan products here that you might have elsewhere. You know, we're a pretty robust bank as far as we have the option to broker, but we also bank. We're a bank, so we have complete control of that transaction. And me and Matt do a lot more thorough job on the front end, just to uncover those kind of potential hiccups. That's why we go through underwriting up front. Because we don't ever want anyone to get into escrow and be like, oh, surprise.
The loan that Eddie
You
was
know-
just talking about, we had that same exact scenario come up. She has a back payment with the IRS. Thank goodness that she
Yep.
in solid. We've been paying every month, and we
Literally
have,
last week.
yeah, we have that program in place, and everybody knows about it, so we're good to go.
But that was before we got into escrow. Like, we discovered this so that if she was in escrow, like, this wouldn't have been, because, even a $200 payment, if you're pushing the envelope on a conventional loan and you're already at, 46, 47%, next thing you know, you go over that and start pushing 50%, you're going to get declined more than likely if you're questionable on your credit scores. If you're below 700, for instance, it gets really tight. Like, the algorithms have gotten very, very difficult to get a pass on anything over 47% debt to income ratio on a conventional loan. So if you're pushing that envelope and then surprise, you've got an extra $200 payment, it's going to put you over. And then the only way to fix it is to go government. But again, going government may not be the solution, because now you might have a government debt in default or delinquent. And
and just tracking income. Now you need a solid 2 years of employment with no gaps. There's a lot of different caveats that come with a government loan that may be acceptable or not acceptable going conventional. So
yeah, very
again,
true.
a lot of caveats.
Yep. Cool. Good question, though. Anybody else got any questions for us? What you guys are seeing out there?
Sorry.
Yeah.
One last thing. Because I actually have a potential seller who is upside down on their mortgage. They're
Oh.
just, not sure if they want to list because they have like 3 big dogs. So finding a place to rent is difficult.
When did they buy a house?
I think it was in 2021. And they're already upside down on their mortgage. Yeah. And it was an investment property that they bought. And the second unit, they were renting it out, but then the tenant was an issue, so they had to get rid of him. And so now they have, like, it's just a mess, basically. So can you go over, you said something about doing it for the sellers, the cost analysis, do you think?
Yeah. So, I mean, you have to have some equity in your home in order to be able to use that to pay off the debts.
Ah, got
right?
it. Okay.
If you're buried in your house, then you're in trouble.
Yeah.
You're gonna
Okay.
have to come up with cash to get.
Well, especially if you're not making your mortgage payments, like, you got to get that solved ASAP, or you're going to lose the house.
Well, hopefully they're making their mortgage payments, but I mean, at the end of the day, you have to have equity to be able to pay off and consolidate debts.
Okay. Got it.
Yeah.
Sorry.
No, don't be sorry.
I don't know why I'm saying sorry, but thank you.
It's all good. So, yeah, you guys, I mean, look at everything from cost of waiting to comparing properties, debt consolidation. We have calculators on paying points, buying versus renting, appreciation, amortization, showing people what affordability looks like. And then, like, real estate report cards. Like, we have all sorts of really cool tools in this software that we use. I mean, probably, one of the most important parts of this software is really the fact that we watch the markets live every day, so that if anything does pop up, it tells us right away. We get updates every morning. They come up and they give us, anywhere from 5 to 10 minutes of an update on what's going on in the market. They tell us whether or not we should be floating. They give us all the updates that we should anticipate that day. But then we also see what the bond markets are doing. And so this really helps us in determining whether or not it's a good time to lock in a rate for a client. So you do get into escrow, and we do wind up following the bond prices. So we know that as prices fall, interest rates are going up, right? And so we can see where there's resistance levels for those interest rates. We know that if it bounces off of this, then we should wait a little while, right? So that they get slightly better rates. If it goes down through here, you see that we do have a huge gap where if it does bust through these resistance levels, it could get a lot higher for interest rates. So, and again, this is basically all caused by that debt ceiling conversation that they're having. So utilize all the tools that we have. Reach out to us if you guys have any questions about anything. We're here to help however we can, you guys. Well, hopefully today has been beneficial. Hopefully you guys learned some new stuff. Saw some cool tools. Let me stop sharing for a second. No new share. Stop sharing. So yeah, hopefully you guys, any other questions about anything? While we get before we get the week started? No? Okay, cool. It was good to see you guys. Good to see all your faces. Thank you guys so much for joining us. We're around all week long. Hit us up if you need us.
Thank you.
I'll see you guys later.
Bye.
Yeah, Julie.
Okay.
I want to just piggyback off of what Hope shared about like people being upside down with their mortgage.
Yeah.
I think that so as you see, like the credit card balances are getting higher, people might be getting like they can't afford to pay. And if they have equity in their home, how can I talk to them about, we can have somebody look at that and help you figure out how to use your equity to help pay down some of your debt.
So there's a couple of different, there's 2-3 different methods we could use, right? First thing that comes to mind is a home equity line of credit, right? So if someone does not want to sell their home and they want to tap into their equity, they can apply for a home equity line of credit. There's certain parameters at which how much equity they're allowed to, that they need to leave in the house,
Okay.
tap into, right? A lot of times it falls between 75 and 80% is the maximum loan to value that a bank will go with, okay? And so they could take any kind of differences they have. The other thing they could do is a cash out refinance, right? That is definitely a lot higher percentage that they can go on a loan to value basis to pull money out. Now, granted, if they did refinance in the past 3 years, they will be agreeing to a much higher interest rate than they're accustomed to.
Okay.
So their payments will go up quite a bit. And it may or may not make sense for them to do. So something that we can evaluate for them. The third option, obviously, is to sell their home and to buy something else. And then they can use that equity, pay off a portion of their debts, and then reinvest the rest of the equity in a new home. But there are costs involved in doing that. Obviously, they got to pay you 5, 6, 7%, right, in the transaction. That's a lot of money. And on top of that, they're going to be going with a much higher interest rate from what they probably have existing. So their payments will probably go up. But again, if they're making more money, not a problem. If they save some money, they want to put some more money down, not a problem. But more than likely, if they're doing this to get out of debt, then they don't have that savings, and they're going to be rolling over whatever's left over.
Okay.
So again, these are all conversations. These are all calculations that we can do for our clients. If you come across that, those are the 3 primary options that someone may have.
Okay.
Again, home equity line of credit. And you can do a variable home equity line. You can do a fixed home equity line. I mean, there's a whole sorts of equity options, equity loan options with that. Refinancing, selling.
Okay. Thank you.
I think that's the only 3 options that I can think of, unless someone else has got anything else. Yeah, no. Okay.
Okay. Thanks.
Yeah, absolutely. Cool. Kristen, sorry you just joined us. We're about to sign off. But
She's here. Let's go.
yeah, but everything is recorded. And it's going to be on my YouTube channel, and along with the cost of waiting analysis, I'll download those and I will upload those onto our Facebook page so you guys can see what they look like. And if anybody ever needs one, just hit us up. Cool.
Thanks, Eddie.
Yeah, you bet, man.
Thank you, Eddie.
Have a great week.
You're a
guys.
sweetheart.
See all you guys.